Okay guys, so in this video we are going to be speaking about Wyckoff. Yes, we're finally here. The thing that I kept saying, we're gonna get to it soon, we're gonna get to it soon, we're gonna get to it soon. We're finally in the topic of Wyckoff, okay? So Wyckoff is called a schematic. Wyckoff is a schematic, meaning what? Wyckoff is something that takes place on the charts every single time, on every single time frame, okay? So if I just go open up Euro USD, or should I do it on US 30? Okay, okay, cool. So Wyckoff was founded by a guy called Richard Wyckoff, okay? He was founded by a guy called Richard Wyckoff, and he was trading stocks, and he found that Wyckoff is a schematic that takes place on stocks in a form of accumulation and distribution, okay? So simply a guy called Richard Wyckoff, and he found this holy grail, not to use that word, but he found this holy grail of a strategy, okay? So what Wyckoff is, I'm going to be using my whiteboard over here because I've drawn out the schematic, but I realized that I can't show it on my whiteboard because my notes are there and I'm going to have to, so I'll just draw it on the screen, no problem, okay? So what Wyckoff is simply what I've been showing you guys this entire time. It's doing the opposite of what retail traders are doing in the market, okay? And it's funny enough, this is actually the live chart for Euro USD right now that I have in front of me. I haven't even, this is the live price right now, but I can see Wyckoff right now off the top of my head. I can see it clear as day, okay? But before we show it in the form of a chart, I'm going to draw it out for you guys, okay? And show you how it looks. So at the top of a market, we look for Wyckoff distribution. At the bottom of a market, we look for Wyckoff accumulation. This video is going to be Wyckoff distribution. The next video will be Wyckoff accumulation, okay? So what I want to do is I want to draw a rectangle here first, okay? I want to mark out this area, okay? I want to mark out this area, and I just want to use the plane box, okay? So I'm going to use this path, okay? I'm going to use a path, my path tool, just to show you guys exactly how Wyckoff looks, okay? So first of all, in a distribution, in a Wyckoff distribution at the top of a market, what we look for is we look for a move up. Once we got the move up, we look for something called the preliminary supply. So this now becomes the preliminary supply. Okay, so the top here, this is the preliminary supply, PSY. You don't have to get too caught up with, oh, why is it called that, etc. Okay, preliminary supply. This is the preliminary supply before the next move takes place. Before we have what? A move to the downside, which is called an automatic rally. AR. We call it an AR, okay? And I ain't talking about no assault rifle. So we call it an AR. Okay, then we have the buyer's climax, which simply means where buying pressure finishes, okay? The buying pressure here is done, long-term wise, okay? So obviously there's gonna be another move up, but for the trend to die out, we call this a buyer's climax. This is where the buyers are going to get taken out of the market. Then from the buyer's climax, we'll have another move down, and then we'll have another move up to test the buyer's climax. This is called the secondary test. Okay, we call this the secondary test, ST. Okay, then from the secondary test, you might have a move down that takes out the automatic rally, and then it pushes up. We call this the up thrust, the UT. We call this the UT. Okay, and after the UT, price will come down for a little bit. Okay, you might do something like this, and they have one final move to the upside that takes out the up thrust, and we call this the UTAD, the up thrust after distribution. UTAD, up thrust after distribution. Okay, after the up thrust after distribution, what happens? Okay, so you need see this with me, guys. Okay, so over here we have the buyer's climax, secondary test. These are two points of liquidity. Okay, what happens here? Price pushes up, liquidity gets taken. So price pushes up in the form of an up thrust. Okay, where was liquidity before that? Liquidity was where the automatic rally was. But what happened is the UTAD, before the secondary test, the move after the secondary test came down and took out the automatic rally. Stop losses were here. Okay, that was liquidity as well. So the up thrust happens, the up thrust comes down, people are selling the market, but they're selling the market too early. They're getting into trades too early. Why? As smart money concept traders, as Wyckoff traders, that's what we are, Wyckoff traders, We're waiting for that final push up to take out the last point of liquidity, the UTAD. And then we look, we're not entering yet, we're waiting. We are waiting. What are we waiting for? We are waiting for a break of structure. Okay, so waiting. So price might do something like this, and then it will break. Okay, it will break here. We call this a change of character, not a break of structure, a change of character. Why is it a change of character? Because price pushed up and then it broke past the last point that it was holding. The last price point that price respected that it was holding has been broken. So we notice that the pair that we're trading, Euro USD in this case, is acting a little bit strange. It's moving a little bit different. Why is it moving a little bit different? Because it was about to go up, but it broke the last point that it rejected. Why? Because this is called a change of character. So we mark this as CHOCH, change of character. Okay? After that, after the change of character, what we are waiting for is, so after the change of character, there's usually a point, we call it the last point of supply. The last point of supply is where we now look for a unmitigated order block. Do you guys remember? We're looking for supply levels here, right? We're looking for the order block that looks something like this. Okay, we're looking for an order block that looks something like this. Okay, something like that. You guys get the gist, right? Okay, remember the order blocks that we spoke about? If I just color this up quickly. Okay. We're looking for this order block. So what do? We take our rectangle tool, we draw a box around it, and we are looking to enter the trade off of this level once we have a break of structure on whatever time frame or a change of character. So we call this a break of structure. So we call this a break of structure slash, okay, so we call this a break of temporary structure. That's why we call it change of character, because it's acting up. But the official break of structure would be below here, below this level. So now what we're waiting for is, we are waiting for price, because it just changed character, we're waiting for price to pull back to this level and then drop from here. And now we can use our first profit target to be these equal lows here. Wherever you see a low in the market, okay, wherever you see a low in the market, that is a point of liquidity. I already spoke about this in the liquidity video. So these are called here, these could be a potential equal low. Mark it out, equal low, EQL, okay? So now over here, what we're doing is we are trading this market. We enter from here, our stop loss goes above the box. And guys, remember, over here, this entire schematic that you see taking place, the Wyckoff schematic, this entire thing to retail traders is consolidation. But to us smart money concept traders, this is nothing but distribution. Price is distributing in order to make the move. Whereas retail traders are staying away from this right now. Or they're trying to buy low, sell high, etc. But we're staying behind. We're watching from the outsides, okay? So we wait for the last point of supply. This is called the LPS. This is called the what? LPS. LPS. We can call it LPSY. Last point of supply, right, LPS, okay? So over here, this is where we enter the trade, okay? And we target, our first target is here, and then we can let the trade run for even more longer if we find more other targets below, okay? And we're gonna make a video about how to find your take profit targets, okay? Don't worry. So this is what we wait for. And now once price, okay? Once price breaks structure, once price breaks here, guess what's gonna happen? You guys can see this drop from here to here is quite a big of a drop, right? So what we're going to do is we are going to look for another last point of supply within this, okay? So really and truly, we are just basing off the we entered this trade based off a change of character, but for more confirmation, for confirmation of Wyckoff, you always want to wait for structure to be broken. Once structure is broken, guess what's going to happen? You're going to get another point of another last point of supply somewhere here. Okay, let me just clone this. Okay, in the form of what? A bearish engulfing. This is a bearish engulfing. You're gonna see this pattern. You're gonna see this pattern, guys. So what do we do now? Knowing what we know, we're gonna get a rectangle tool. We're gonna put it from the high of the previous candle, like we've just learned in the previous videos, to the lowest of the previous candle. And we are waiting to take the trade from this level here. So now we're waiting for because price has officially broken structure. Once price pulls back, once we get a pullback, once we get a retracement, we enter the trade based off of the LPS, the last point of supply. And now we can look to target even lower than these lows here, and we can hold the trade for a while. Okay, and that is an introduction to Wyckoff distribution. Now, all you need to know is Wyckoff distribution. Find it at the top of a market. Okay, you can find it everywhere, but the best places I like to enter to avoid traffic, to avoid all the noise, to avoid wherever everybody's entering, is at the top of a market. So whenever price is at the top, wait, because whenever price gets to the top, people see this drop, they start selling the market. Price goes up, their stop losses get hit. They're thinking, oh, price is dropping again, let me sell again. They sell again. What happens is price comes back up, hits them for break even, their stop losses get hit. And now price drops again. They're thinking, oh damn, it's a break of structure. Yeah, now for sure it's gonna drop. They enter sales again, price goes up. Let me just show you guys quickly one time. Look, people are seeing this price market to drop. Retail traders, they're getting in here, they're putting a stop loss above here, and the take profit was all the way down there. What happens? Price comes up, hits their stop loss. Cool, they're out the trade. Now they see price, what they see price dropping again. They're seeing, oh damn, okay, cool. Let's enter the trade now because I've got stopped out previously. This must be the real move, right? Cool. So now what happens is the stop loss goes below, the take profit is all the way at the bottom, price pushes up, hits their stop loss again, no problem. Now they're seeing, oh damn, okay, there's a break of structure right here, price broke structure, so surely this must be the move that I'm looking for. They sell the market again, their stop loss goes below, goes above the previous high over here. What happens is they're waiting for price to drop, price does not drop, price goes the opposite direction, hits their stop loss, and they've lost money again. This is why whenever price reaches the top, we don't say buy low, sell high. Because if everybody's selling high, then everyone can make money. And this industry is based off of liquidity. You have to know how to trade like professionals in order for you to become successful in the market. So we're waiting. We are still waiting. We are, whenever price is at the top, we're waiting for Wyckoff distribution to take place. And this is all we wait for. We're waiting. Cool, price is going up. Price is coming down. We're sitting on our hands. We're not trading. We're watching. We're waiting. We're waiting for people to get liquidated. We are waiting for people's stop losses to get hit because we are not stupid traders. We are smart money traders. We're waiting. So we wait. Buyer's climax, no problem. We know that it's buyer's climax. The buying pressure is done. Price drops. Price goes up. Price comes back down. We're waiting. We're waiting for our up thrust. Okay, we get an up thrust. Price is dropping. We're still not FOMO. We still don't have the fear of missing out. We're waiting again. Price comes back down. Price goes up. We get our UTAD. We're thinking good, lovely. Liquidity got taken here, 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 and we are left with what? We are left with a clean, unmitigated order block that we call a last point of supply. We now enter from that last point of supply, we target the equal lows, and we bank our first take profit. And now we wait for the break of structure. Once the break of structure takes place, we wait for a pullback, we wait, price will print a last point of supply, it will print another order block after it breaks structure, and we enter off of that. And we ride the trade all the way down to a long, high RR trade. High RR meaning risk to reward. We always want we want to risk very small and make very big. We want to risk 1% of our capital to make at least 10, okay? So we want to make at least more than 3, okay? So in this case now, this is the reason why I told you guys to make 100k demo accounts, because I want you guys to get comfortable with seeing the big numbers and seeing drawdown. I'm trying to prepare you to take a funded challenge. So when you do feel comfortable with the information that you've learned and you practice and you backtest, guys, I'm giving you the blueprint. It's upon you now to backtest this. You have to do your own revision, okay? You have to do your own revision, practice this time and time again, and then when you feel confident, take a prop firm exam, because you will be able to pass with flying colors, you know, like you're only risking 1%. Say for example, in this trade now, I had a stop loss of 1k. This was a risk to reward of, what was this a risk to reward of? 1 to 17. If I just risked 1k, I would have made 17k from this trade, just by risking 1k. okay? And with prop firms, you can easily do that. Why? Because you have the capital to do so. It's not your own money. All you have to do is prove to someone that you can trade, and they will give you income to trade. And then you can, from one withdrawal, guys, you can make 100k, 80k, 50k, 20k. It's up to you. The opportunities are endless, you see? But this is the strategy.